Hi, everyone. Welcome back from your vacations and welcome to another episode of the New York Alternative Investments Roundtable Lunchtime Webinar Series. My name is Jason Eisman, Assistant Vice President at Hub International and moderator for the webinar. For those of you who are new to the Roundtable, we're a nonprofit organization whose mission is to provide a forum for thought leadership in the Roundtables. I apologize. We're a nonprofit whose mission is to provide a forum for thought leadership and knowledge sharing in the alternative investment space. Special thank you to our sponsors who allow us to achieve this mission by hosting monthly webinar events and in-person events in New York City. If you're interested in becoming a sponsor or learning more about sponsorship, you can consult the website ny-alt.org or reach out to me on LinkedIn. I'm very excited to introduce our guests. They're special, near and dear to me. They're colleagues of mine at Hub International. With that, Chris, I'll let you start.
Okay, great. Chris Feber, thanks again for including us today. We're really looking forward to today's conversation. My role is I lead the financial sponsor coverage efforts here at Hub International. And similar to Jason, I'm excited to sit alongside both my colleagues, Dave Garrigus, as well as Marty Moss. Dave, do you mind quickly introducing yourself?
Sure, happy to. Dave Garrigus. I lead a specialty practice within Hub that we call ProEx that focuses on executive liability, professional liability, technology and cyber risk, and of course, transactional risk.
Great. Thanks, Dave. Marty?
Marty Moss. I run our surety practice here at Hub, both locally and nationally, based out of the Chicago, Illinois area. Surety is one of those small products that you don't realize you need it until it pops up on your desk one day. So happy to talk through that a little bit more today.
Awesome. Great.
And just
Um,
sorry, Chris, before we get started, I just want to let everybody know that this webinar will be recorded and posted on the Roundtable's website for future use. And if you have any questions, feel free to put them in the chat, and I will be monitoring and let the panelists know as they come in. With that, Chris, back to you.
Okay, great. That's exactly what I was going to say, which is we hope this to be not only informative, but also hopefully interactive. So if you do have questions or you want to dig in and really get into the weeds, by all means, feel free to pose a question in the chat. So we've got a handful of questions that I'm going to sort of take both Dave as well as Marty through. But again, if there's other things that you want to address, feel free to throw them into the chat and or we can hold until the end of the conversation. Dave, I'm going to start with you, and then I'm going to move over to you, Marty. But first and foremost, clearly speed, certainty, and ultimately getting deals done in today's environment is critically important for all different types of financial sponsors. And so, if you can talk a little bit about sort of the transactional risk insurance product suite, and more specifically, where we see not only these types of products removing friction, but ultimately generating better outcomes, I'd appreciate it.
Yeah, sure. Happy to. First of all, if you think about representations and warranties insurance, certainly it is insurance, but it's not just a risk transfer product. Fundamentally, it's a deal friction removal tool, right? So we think about it accelerating deals by simplifying indemnity negotiations, reducing or eliminating escrows, creating clarity on post-close risk ownership. So it really is intended to help ease friction in transactions. Now, from a capital standpoint, less money trapped in escrows, of course, means a better IRR and faster capital return to LPs. If it's a competitive auction process, it enables cleaner, seller-friendly bids without taking uncompensated risk. And, look, post-close, the claims go to the insurers, not the counterparties. So you reduce disputes and you preserve relationships. Really thinking about all of that, what that means is faster closes, cleaner exits, and more efficient use of capital.
Awesome. Marty, talk a little bit about the surety market and sort of where you've seen and where your team has experienced ultimately the proper use of surety to not only reduce and or remove obstacles and or improve better outcomes, specifically in the context of leveraged private equity or LBO transactions.
Yeah, absolutely. Surety is one of those products, right, where it's maybe in 3 or 4 out of every 10 deals that you come across, right? It's not something that's you're going to be a lot of private equity and institutional investors that we get involved with really don't have a working knowledge of it. It's something that you really don't understand until you get into a deal and realize, usually when we get called in is it's an afterthought, right? The company has surety, all of a sudden they're going through a leverage buyout or transaction, and all of a sudden at the 11th hour they realize that their existing carrier does not want to support the structure that they've put in place moving forward, right? So it's one of these ones that if you see, part of this is raising awareness, right? If you do see surety on a deal and it's a credit backed product, and if you are going to change the complexion of a balance sheet through the transaction, which 99.9% of the time you are, right? They're viewed as an unsecured creditor. So the moment you add additional debt onto a deal, there's some sureties that don't love that type of structure, right? So it's something that really, creating awareness of bringing in a broker and advisor ahead of time, making sure that you're looking at what the transaction is ultimately going to do and how that's going to impact your surety program ultimately, right? And so there's a few different options as you look at surety when you're looking at it as relates to a transaction, right? Existing surety bonds in place and then future go forward program, right? And then also using surety as a liquidity solution to help free up capital. As Dave mentioned before, you want to maximize your IRR and be most efficient as you can with capital, right? If you have a letter of credit requirements or liquidity requirements, right? You possibly using surety as a tool to replace those, so you don't have to tie up additional capital or liquidity that you can go use on other acquisitions. So, I think the biggest thing when it comes to closing a transaction is actually thinking about and understanding that there is a surety program, that it might not necessarily continue as it is post transaction, and getting ahead of it and understanding how any changes to the balance sheet, any financial transaction might impact that program.
That's great. No, thank you. Let's move on to ultimately where when people think about risk allocation, when you think about deals getting complicated, let's face it, no deal is straightforward in today's environment for a whole host of reasons. But maybe we can spend a minute or two talking, Dave, about not only some of the challenges, but also some of the implications. And then I think more specifically, if you can comment on where you've seen and our team has seen the proper use of the various different transactional risk insurance products in the context of carve-outs, cross-border transactions, distressed transactions, or for that matter, where people are using traditional transactional insurance products in lieu of traditional indemnification packages.
Sure. Yeah, absolutely. So first of all, we love complexity. One of the great things about the team at Hub is that we have a tremendous amount of experience that we bring to the table. And in cases of complexity, I feel like we can really distinguish our approach more so than on a straightforward deal. Important to understand is that complexity does not eliminate the need for reps and warranties insurance. It just requires more intentional risk allocation. So let's kind of think about some of the scenarios that you raised, Chris. Carve-outs. The biggest thing we run into on carve-outs is, first of all, reps and warranties insurance works, but insurers are really focused heavily on separation readiness and also diligence quality. We often get the question, is that a tool to be used in place of diligence? And the answer is no. It does not solve for incomplete diligence. Reps and warranties really presumes that a fulsome diligence is completed. On cross-border deals, somewhat similar, very effective for core operational reps, but they're going to look closely at diligence around tax and regulatory and enforcement risks to make sure that those are clearly scoped and diligenced. From a distressed deal standpoint, or where you have high-risk assets, I would say, of course, we pay attention to ways in which coverage may be narrowed and or retentions are impacted. But really, reps and warranties insurance complements pricing and structure on the deal. It doesn't replace them. So a key mindset shift is deciding which risks belong with insurance on those deals and which belong in price or structure.
Awesome. And we're going to spend a couple minutes a little bit further along in the conversation talking about some of the new applications and some of the newer use cases, I should say, for some of these different transactional insurance products. So appreciate the comments, Dave. Marty, back to you in terms of surety and letters of credit and sort of unorthodox transaction types. Can you talk a little bit about sort of what's working, what you're seeing, and ultimately where clients are ultimately having success, or for that matter, challenges around the use of surety in the context of some of these more complicated transactions?
Yeah, I mean, biggest thing, right, as I touched on a little bit earlier, was having an existing program, and at the 11th hour finding out that you might not have capacity post transaction. I'll give you a couple of examples of that, right? As we're sitting here talking, there's been what we have to step back and realize a lot of times there's two types of companies you're buying, or there might be more, but like simplistically talking, right? You might have a company that has recurring revenue that sets itself up pretty nicely for private equity investment. But what we're seeing a lot right now is a lot of money going into construction and project level work, right? And growing that business from there. As you're taking a company like that and maybe buying it or acquiring it as a platform company for a roll up potentially, right? You're seeing a mom and pop owned company that's selling over to private equity. Maybe you might have second generation, third generation that doesn't want to manage the company anymore. You're seeing a lot of it being used for continuity purposes, right? And so you have a much smaller company now getting bought by an institutional investor, private equity firm, right? You name it, that has some pretty deep pockets, and you automatically assume, right? By virtue of us buying them as a big company, big balance sheet behind this, it's going to be a better deal. It should automatically be a great obligation for a surety. Why wouldn't they continue to support us, right? And actually, you see the inverse. What happens is them viewing themselves as an unsecured creditor, you toss a bunch of debt on the balance sheet. They view that to sit in front of them now. So now, rather than a mom and pop shop, you have a big institutional firm buying the company, and actually the terms will sometimes get worse, right? And the assumption it's never assumed that way. So we get brought in at the 11th hour saying, we didn't realize this was going to be an issue. We don't really have too many other deals that have to deal with surety, right? We're now finding this out at the 11th hour. We don't want to close. It's an inherent risk. We don't want to close without knowing we have a program in place. And that's where we're getting brought in on a lot of these transactions. So I think some of it's thinking through that and understanding that, and then aligning yourself with probably a replacement surety that's going to give you a program post close that's going to allow you to then go out and bid, and then also understanding the economics of that, right? Sometimes the pricing might increase, on a really distressed deal. And I know that's where we're going with this transaction here, or with the question here, is on a distressed deal where maybe you're carving out a group of assets and you haven't capitalized it well enough. Some sureties are going to ask for collateral in that case. I think that's where just working and understanding those concepts and making sure that you capitalize that company well enough to use that capital. You don't want to have to get to a point where at the 11th hour you realize you have to post collateral against your surety bonds going forward and tie up unnecessary cash that you're otherwise trying to use and invest back in the business, right? And I think that's what's tripping up our clients a lot. Where we found success on our end is putting programs like that in place, and at the 11th hour trying to throw a Hail Mary and get that all put together so they can close. But it becomes a major stress point, and sometimes pushes closing in certain instances. Or you're counting on some of these larger contracts that are bonded as your business case, right? There's some really strong EBITDA, there's some really strong margins on these jobs. You can't get a bond to support those going forward, right? You might eliminate some of that return that you were looking for. Or if it's more costly, more pricey, you want to start factoring that into some of maybe your holdbacks, as you're structuring these transactions. So these are things that we're making sure we think about, as we go through a transaction and structure those transactions. But I think those are really the kind of the buy side as you're taking on some of those project level companies. As we're starting to see some divestitures and some other things, right? I think the biggest thing is limited capital that's being thrown in the company. I think we're trying to go pretty capital light, and more efficient, which we understand from an investment standpoint, but that doesn't always align with the surety's needs. So I think that's thinking through some of these before a transaction's consummated, before you get blindsided after a transaction's done.
It's great. Appreciate the color commentary, Marty. Just to be clear, corporate carve-outs and cross-border transactions are not out of bounds in the eyes of the surety bond community, correct?
No, no, absolutely not. It's just, structure means they're not out of bounds. It's just structures everything on those types of deals,
Hmm.
right? Cross border, corporate carve outs, they make sense. And there's definitely, we have. I'll just give an example. Talk about some of the carve outs. We've had some big public companies that will carve out some certain units. I'll say divested, but not really. But if they take some of those units private, they can usually run those with higher leverage, right? And get a better return. Whereas, your public shareholders, public investors aren't going to appreciate some of the leverage you're going to have to toss on that company to make it a better investment. And then they'll ultimately buy it back, right? To make those investments, they probably have to lever it up a lot more, 6, 7, 8 turns. Where for a public company, that's not going to necessarily make sense. So, I mean, again, it's just doing it in conjunction and eyes wide open with the surety that they're on board, can be really meaningful and accelerate returns. It just has to be structured correctly.
Awesome. Great. No, thank you. Let's move on, gentlemen, and talk a little bit about sort of best-in-class behavior and some mistakes and sort of lessons learned, having done this now for collectively, I think, close to 75 years for the three of us. Dave, I'm going to go back to you and start with you. Can you talk a little bit about where most often we see value sort of left on the table and or sort of common mistakes, and then conversely, maybe you can talk about sort of best practices around all things transactional insurance products.
Yeah, happy to. Well, kind of first and foremost, from a common mistake standpoint, and look, this isn't always a mistake. Sometimes there are factors that lead us down this road, but I would say timing is the biggest one. Bringing reps and warranties insurance into the process too late. We can run into things like late diligence issues. When you do that, you're missing opportunities potentially. Bringing it in earlier and including it as part of the initial negotiation. But some other mistakes that we see, look, reps and warranties insurance at its core, one of the values that our clients see in it is in the ability to reduce or even eliminate an escrow. We see transactions, though, where there's still a meaningful escrow layered on top of the insurance, and you're over securing the risk. And we also at times see organizations treat, or buyers or reps treat it as a one-off checkbox as opposed to a repeatable strategy. So when we think about kind of what I think, Chris, you characterized as more best-in-class behavior, it's integrating reps and warranties early into the deal structuring. When you can use it as a tool to reduce or eliminate the escrow requirements, you may improve the likelihood that your bid is successful and make your bid more attractive. It gives us more time to negotiate with underwriters and make sure that we are securing the best possible terms and structure for the transaction. So I would say that organizations who use it deliberately to improve bid competitiveness and certainty really benefit even more from the transactional risk product. And then taking really more of a portfolio view. So think about this not as a one-off transaction, but leveraging repeat insurer relationships where a sponsor develops a very solid and repeatable relationship with a transactional risk partner. Often that eliminates potential bumps in the road. It can help improve pricing across a portfolio. And so it's really thinking about process discipline as opposed to that one-off kind of aggressive last-minute negotiation. So I would say as a bottom line, early planning, consistency create better outcomes than late-stage leverage battles.
Awesome. A couple other things I'll just add on that front is it's imperative that the financial sponsor perform what is sort of standard and customary due diligence specific to the industry that they're investing in. So an example of that would be healthcare. No reps warranty insurer is going to take comfort knowing that you didn't perform sort of billing and coding due diligence per se. Or if it's a business in the industrial space and it's had a checkered environmental history, they're going to want to understand why or why not did you not perform ultimately some form of environmental due diligence or some form of phase one or phase two for that matter? And so I think each and every industry and each and every transaction has its own nuances, but these insurers are evaluating thousands and thousands of opportunities in a given calendar year. And so they have a sense for what is appropriate for not only types of transactions, where the target's based, ultimately the industry it participates in, and so forth. So thanks again, Dave. Let's move on to sort of lessons learned and best practices around all things surety. And maybe, Marty, you can share with the group maybe some horror stories, or for that matter, some things that you have witnessed over the years that hopefully you won't have to witness again in your career.
Yeah, where do I start? No, so there's been a few, right? And there's some emerging trends right now, right? I think that the issue here in the surety space, it's a smaller, fragmented market, very specialized, right? Where private equity might get a bad rap, private equity financial institutions, mainly because they're not necessarily prioritized in certain events. And I'll say, there's a lot of let's say Chapter 11 filings and that right now, and in the past where they haven't played out well, so we get lumped into this general private equity bucket. We'll say it right, where they're not all deals are the same, even not all bankruptcies are the same. And I'm going to say bankruptcies just because that has caused some losses in the past 5-10 years. There's even some larger ones out there right now where it makes sense from our standpoint, and from the investor's standpoint, to possibly file Chapter 11 and reorg, but during the process they might have caused a loss to a surety, and that ultimately might even like blackball them from getting support in the future. And so it's important to think that like there's certain markets with certain lists of firms that if they've caused a loss in the past, they might not be able to get support in the future. So it's just something that's something to think about. But we're also seeing right now in the marketplace are longer hold periods, right? It's a different environment, and I know we'll touch on CVs and a few other things in the future, continuation vehicles, right? But we're seeing a large shift right now are longer hold periods, wanting to get investors' capital back, right? One of the bigger no-nos right now is a recap and dividend distribution back to a private equity owner on what might be an already over leveraged company. That's something that we're seeing right now that's starting to hurt some of our surety programs, right? You look at them as an unsecured creditor, and you look at the equity partners and their dividend recapping and paying themselves, it just looks like they're prioritizing themselves ahead of time. And we get it, right? Like you might be in a deal for a long time, you might have a longer hold period. You need to show liquidity to investors and return to investors. Maybe you have a fund window that's closing, you need to roll to a new fund, right? There's a lot of things going at play, but a lot of it's around messaging and how you make that work, right? There's ways to do that and message it and show it correctly. And we get, you want to recap, you want to show a return to your investors. But there's ways to do that and still maintain your surety program. There's ways that are going to cause red flags. And I think that's the biggest thing, pure dividend recap with nothing else new being brought to the table is probably going to give some pause and cause for concern on the sureties end. Maybe cause some collateral, some higher rates to come into play. But there's ways to structure that. We've seen merger of two portfolio companies that are both in old funds coming into a new fund together collectively with new investors. Kick out debt maturities, recap. You're still paying a dividend in return, but at least we're showing and demonstrating you're adding value. So there's ways to do it without it impacting your surety program. But that's one of the bigger things we're seeing now, on the recap side. And a lot of sureties are taking notice of that right now.
Makes sense. No, appreciate the color commentary. What I should have asked this question at the beginning of the call, but Marty, can you just sort of comment quickly on sort of the universe of sureties in let's say the U.S., and more specifically those that are interested in pursuing opportunities involving sort of businesses that have either some form of institutional backing and or leverage on the balance sheet?
Yeah, it's a good question, right? So in our universe, there's probably 100, maybe more sureties specifically. There it gets significantly smaller. Really, there's 40 sureties that are active, and I'd say 40 or so that are active in writing larger program business, right? And then as soon as you get any type of institutional private equity involvement, there's at least half of that. I'd probably say, majority of that, they'll say we'll look at private equity, but they'll look at maybe a family office deal where they're going to buy and hold the company for 15 years, right? So when you really look at the ones that play well with institutional investors, it's probably 5 to 10 out of the entire
Yeah.
universe that really do it well. And it's important to align yourselves with them. And structure is different too. Transaction structure is going to be different. Where one surety might want to be, without private equity involvement, might want to be the sole surety. On the other side, you might have to syndicate programs across multiple sureties to much like you would a banking syndicate. So um, it's a little bit of a different strategy once you have an institutional investor involved.
Awesome. Great. No, appreciate the comments, Marty. Dave, we're going to move back to you and talk a little bit about continuation vehicles because clearly the GP-led CV market has exploded in North America over the course of the last few years. Can you talk a little bit about not only what's different, but also where does it actually add value, specifically reps warranty insurance?
Yeah, sure. Well, to start, I mean, you're right. Continuation deals are different. They're different in many ways because of conflicts of interest. Insurers focus less on traditional diligence volume and more on things like process integrity and disclosure quality and governance and fairness. There are some pressure points for underwriters, things like kind of independent valuations or fairness opinions, clear LP disclosure, credible lead investor involvement. But all of that said, RWI, reps and warranties insurance, still adds value. It adds value because it aligns the selling LPs, rolling LPs, and the GP. It provides an independent backstop where indemnities are really impractical. And like we talked about earlier, it reduces post-transaction tension. There are some places where it may not add as much value. Things like simple rollovers with aligned investors and limited third-party risk, maybe it doesn't add as much value. But overall, reps and warranties insurance enhances alignment on these transactions. So hopefully that helps.
Yeah, no, there's clearly been an uptick in utilization around reps warranty insurance in this space. And we estimate as a group that nearly 2/3 of the single asset CVs that were successfully closed last year were insured. Roughly a third, maybe even closer to 40% of the multi-asset continuation vehicles were also insured. We're also seeing greater uptick in the use of insurance around not only CVs in the private credit space, the venture space, and then last but not least in the infrastructure space. So my expectation and my gut tells me is that this market will only grow. And in addition, the insurance market will only continue to support the growth of the CV market here in North America. Thanks, Dave. Appreciate it. Let's move on to, or I should say, get back to some surety topics because I know there's a lot of interesting and sort of emerging use cases. Marty, do you mind maybe just touching on specifically where you're seeing some different use cases in the context of both CVs and also other transaction types?
Mm-hmm. Yeah, if we're specifically talking CVs, right? I think I'd even step back a little bit and say, CVs there used to be a negative connotation with CVs, right? It used to be something that was a little bit, you couldn't really, that the expectation or the understanding was maybe you couldn't get out of an investment, you couldn't roll it, you couldn't sell it. So you pop it into a CV to kick it down the road. Now it's actually a business strategy, right? You might actually have a really strong performing asset. You might want to return some liquidity, switch out investors, and roll it into a new CV, right? There's a lot. It's a lot more common these days. So there's a lot better connotation around a CV than there used to be. So we are starting to see that be more prevalently used, and getting more support, right? It used to be probably negatively viewed as from the surety space, and now you're starting to see it a little bit more, and get a better understanding around that. And there's more awareness around CVs. But when I think, traditionally with a number of surety programs, right, a lot of times it was very reactionary, right? If the company has surety, you're going to put, you're just going to replace it or just understand the needs and go forward with that and just, whenever you need a bond, go try to get one. Where now, there's a lot more focus on using it to your advantage, using liquidity sources, right? So when you talk about insurance collateral, when you talk that you might need to post on maybe a high deductible program, when you go in, you can use surety for that type of an arrangement and to secure that so you don't have to tie up letters of credit and cash, right? Maybe some of our waste and environmental obligations, you might have an old legacy company that has a letter of credit posted for some environmental obligations or, escrows. We've seen court cases and court litigation where been required to put the escrows in place and they just sit there, right? And there's trust in place. Well, when you go in and you go in as a new company, you can use surety bonds for that, right? So you can free up cash and capital for those transactions, especially we see it a lot in the waste space, right? With landfill owners, right? They're setting aside funds so they can ultimately close a landfill. And the existing owners don't realize they can put a bond in place. And so it actually, I don't want to ruin anyone's secret sauce here, but we've seen where the buyer actually will say, we'll buy your company, we'll take that over, we get rights to that, and they'll just replace that with a bond and now have access to the cash that's been reserved. And again, if you're not going to sit in the deal and you're going to be selling the company to another or maybe another larger provider, specifically in the waste space, this is that's similar, just an example. They're just going to place a bond anyways. And so, why it's not like they'll look that you reserve the cash against that environmental obligation in the future. They're going to make it part of the deal structure. So we're able to free up that liquidity so you can go use it. So now we've actually found additional liquidity to return in the investment that otherwise wouldn't know was there. So there's a lot of alternatives that we're using, kind of going offensively with liquidity solutions as it relates to surety, where traditionally and in the past you just kind of react and just place the needs that they came to you with. So again, when we go through a deal, especially if we're doing diligence on a deal, we won't just ask you what existing surety bonds are in place. You want to see what existing letters of credit do you have in place, any trusts, any escrows, any lease agreements that have securities against them, renewables, power purchase agreements, any type of agreement that might have a security posted against it that's not a bond. You can generally use that. Where you can generally use a surety bond to replace that, and again, free up some liquidity for yourselves.
Great. Thank you. Appreciate it, Marty. Dave, anything else you want to add on the topic of all things continuation vehicles?
Yeah, I would just say, especially for those who've not pursued reps and warranties insurance on a CV in the past, start early. Insurer perception is really shaped long before the underwriting begins. I would say, as with any transaction, advisor selection matters. Insurers really do care who is running the diligence and especially managing the conflicts in these transactions. I'd say be transparent. Proactive disclosure tends to lead to better pricing and fewer exclusions. And design the deal with insurance in mind. Things like clear rep packages and consistent diligent access. And realistic underwriting timelines. Insurers really reward a clean process, in some cases more than even aggressive negotiation.
Great. No, good points. So that all but wraps up our sort of formal remarks. Jason, I don't know if there's any questions in the chat. If so, maybe we can tackle them. If not, perhaps we can open up for Q&A from the audience.
Yeah, so nothing has come in during the presentation, but we'll give it 30 seconds and anybody can type their questions in the chat and we can answer them as they come in. But while we wait for that, I'll ask on the shorty side, is this something that has been gaining more use? And you mentioned that there is a use for liquidity capabilities. Is this something that there's a change in mindset as to how the product can be used? And do you think is this something that's going to continue to evolve with new use cases, or where are we? Where's that going? And anything in between, I guess.
Yeah, I think it's only grown in popularity, right? There's been a number of markets that have continued to pop up, and newer markets, right? As we alluded to earlier, there's not a ton of markets that really understand and do private equity backed deals well, but we have seen continue to see some new entrants over the last few years that have made it more of a commonplace to replace these liquidity solutions, and then also we've had a history of them actually performing. So I guess that just even on the insurance side, right, providing a bond for insurance collateral, you're seeing a lot of carriers now accept a lot more obligations, where in the past it used to be a fiefdom where they'd only accept from set bonds from the larger alphabet houses. But you've actually seen where some of these securities have been called and they've performed well. And so because they perform well, the industry is starting to open up a little bit and get a little bit more uh, uh, accepting of securities from not just your, I guess I'll say it, your Travelers, your Liberties, your Chubbs, your big markets. They'll accept it from those next tiers down, and those next tier down generally have more aggressive appetites. So it's just broadened the product and the where we can use it. So I think it's always been around, but it's just more widely accepted now as you get additional awareness and you've actually had to use it and it's performed how it should.
I think going back 10 years, Jason, to your point, just to add some additional color, there were a lot of investment firms that would, quite frankly, just shy away from opportunities that involved surety. And I think over time, as more and more folks have not only gotten comfortable with sort of how the surety market works, but also they've come to the realization that there are more and more surety providers that are commercial and that ultimately want to work with the institutional investment community. More and more folks have come to the realization that instead of it being sort of an obstacle 10 years ago, it's a opportunity as far as they're concerned. If for no other reason, a lot of these target companies are wildly successful and they represent just great opportunities for growth over time.
Yeah.
Absolutely, that makes sense. I'll reiterate to the guests that you can use the Q&A chat to put in any questions if you have any. Give it another 20 seconds, let those come in.
And if there's other topics that you'd like us to address, please, by all means, feel free to chime in and we'll do our best to answer your questions. Unless there's any other questions, maybe Jason, I'll turn it back to you to close out the call.
All right, one question came up. How do you see the industry's use of insurance evolving over the next 5 years?
Do you want me to take that or you want to take that, Dave?
Sure, go ahead and I may add comments.
Okay, sure. I think more and more what we're seeing is not only the creative use of insurance in the context of getting deals done, alternative structures. So when I refer to alternative structures, I'm referring to things like loss sensitive arrangements. I'm talking about captives. I'm talking about RRGs and the like. And so the insurance industry, by and large, has not been known for its innovation, but I do think the level of innovation has sped up over the course of the last couple of years, and more investors have embraced that to not only get deals done that perhaps were problematic or challenging at the onset, but I think more importantly, they're looking at insurance as a way to drive not just the only way, but one of several ways to create value post closing. And so my expectation is that just when I think we've seen it all, more and more folks are coming to us and saying, look, how can we look at the insurance opportunity here differently leading up to and ultimately closing on a new investment? And then, as important, if not more important, during their hold period and thinking about it differently to not only extract value, but also to build and professionalize the business that they own. Dave?
I would just add to that we also see still a very competitive rate environment right now, and so our clients really look at this as not only valuable for all the reasons Chris mentioned that we talked about today, but also a very good financial trade. With rates where they are, it really has become a no-brainer in most transactions.
That's a great point.
Yeah.
Marty, anything you want to add?
Um, no, I think honestly, I think I think you touched on it. I just saw another follow-up question here about AI, and
Sure.
does it help the industry evolve further in the future? I think absolutely, right? I think we've all had different conversations about AI and its uses, but I think it for the most part it's going to streamline those, let's call quote unquote easier deals that will free up some of our resources and time to focus on some of the more complex deals, and it will really separate those that have the knowledge base versus those that don't. And I think that you're going to see a lot faster response times. You're going to see a lot more complex deals getting done. And also, I think you're going to start to see as you start to see the industry evolve more, they're going to continue to look. They're going to have to find ways to kind of reinvent themselves. You're going to have a lot of people that can focus more on strategy and coming up with different solutions versus kind of being reactive, where they have to be. It's going to free up a lot of time for some of those resources.
I would just say I had a fun question come the other day, and that was, hey, how about we just use AI in place of one of our traditional diligence workstream providers? Um, what I would say is that the reps and warranties insurance market is still not accepting of ChatGPT or Claude stepping in place of a more traditional fulsome diligence. But certainly it can be helpful when utilized as an enabler by those traditional diligence providers in that process. But it's still not being used in place of.
Yeah, that's a great point. That said, I think there's a growing number, and it grows by the day, of our clients, both private capital managers and just alternative asset managers, broadly speaking, that are using AI in some way, shape, or form to not only diligence, but also to look for value creation opportunities amongst their existing investments. Any other questions in the chat box?
Looks like there's no additional
Okay.
questions in the chat box.
Well,
So,
if unless there's any other questions, I'll turn it back to you, Jason. But again, thank you for including us today. Hopefully, this has been informative. And should there be additional follow-up questions afterwards, feel free to reach out to Jason, and he'll funnel them our way.
of course, absolutely. Chris, Marty, Dave, thank you guys so much. And I hope that everybody enjoyed this conversation. Great topic, and you guys did a really great job. Thank you.
You're welcome.
Thanks,
Thanks again.
everyone.
Thank you.
Yep, be well.